Let's bring in a guest here, Bob Michel. Bob Michel joining us now on set, talking about maybe this flight to safety that we have had. Bob, it's a pleasure to have you on the program. Dan made a great point sort of at the end of his previous comment, which is the Fed out of gas here? That's part of the, I think that's where you're going, which is that we talked about the Fed making all these easing moves, and if something were to happen, they would be effectively powerless. I don't want to put words in your mouth, but that's kind of where you're going, I think, right?
Yeah, no doubt. I mean, listen, they called it a mid-cycle adjustment, but a lot of people who were skeptical at the time were saying, wait, do we really need this now? Don't we want to save the powder for some sort of event we can't foresee?
So the Fed has 2/3 of the gas left in the tank. They cut rates 3 times. They could potentially do 6 more 25 basis point cuts. We've seen that it helps. We saw with just the 3 rate cuts what happened to mortgage refis and the confidence to the consumer. So it does work. They have plenty of firepower. They also have their balance sheet. Right now, they're just maintaining it. We can debate what the front-end liquidity injections are doing, but they could go back to expanding their balance sheet. There's a lot they can do.
Wait, but it affected risk assets over the last 4 months or 5 months since they really started expanding their balance sheet and cutting their interest rates. But with Q4 GDP is tracking below 2%. So what did it do other than just kind of do what it's always done, is just inflate risk assets?
Well, that may have been one of the things that it did, but there's no doubt when you look at the mortgage market, refinancings are up a lot. And that put cash into consumers' pockets. And when you look at a lot of the economic activity, it was centered around the consumer. So I can draw a hard line from Fed rate cuts to the consumer to spending. And they've got some powder left.
Well, it's not just been here, obviously. As you know, you're the global head of fixed income. I mean, is it the central banks around the world? What is it, 90 total cuts or something like this?
Absolutely. We totaled it up, and it's staggering. Everyone talks about the 3 Fed cuts for 75 basis points. There have been close to 60 central banks that have cut rates 90 times for over 9,000 basis points. So they've literally flooded the global economy with money. And a lot of them have gone back to expanding and maintaining their balance sheet.
So Bob, I'm curious, we were talking about kind of the economic impact here. What's going on in the fixed income markets? You talked about those interest rate cuts. You get 0 yield in Europe. You get 0 yield in Japan, the largest. So does that mean just everybody has to flood into the bond market and we should all buy TLT?
So it's interesting. In the last week, sentiment in the bond market's gone 180 degrees. Everyone around the world was looking for a rally to get out of bonds, thinking with compromise on the trade front, you see some startup of economic activity. Now everyone's thinking about getting back in. It's the safe haven. And as we start to see that play out, and I'm not saying everyone's gotten in yet. I think there's a lot of discussion. People are waiting to see how things play out. It's the money overseas in the negative yielding bond markets that is eyeing the U.S. bond market like a dog looking at a bone and just coming right in.
Let me ask, so today's move, is that all flight to quality? What do you
yeah, I think
if we see a coronavirus sort of tempering?
And I think what's important here, it's the early stages of flight to quality. It's probably a lot more of unwinding of some of the short positions that have been put in since the phase 1 trade deal had been agreed to. I think there's still big money to come into the bond market. There are still central banks that are expanding their balance sheet. I think we could easily do another 20, 25 basis points here. That brings you to about 1.35 to 1.4% on the 10-year, not too far away from the bottom half of the Fed's range, which is 1.5%. I think for it to go lower than that, you would need an indication that the Fed would have to cut rates in here.
So at what cost? At what future cost? I mean, because to me, this is all madness. And I might be an outlier here, but I mean, they're setting us up globally for some catastrophic event. I mean, I don't know what this is the greatest economy in the history of mankind. I read about it all the time and I hear about it, yet we're doing emergency measures. And what's the emergency? So I don't really know what the game of the Federal Reserve is and central banks globally, but at what cost are they doing all this nonsense?
I used to be you. I used to sit
Sorry
there.
to hear that.
I used to sit there and go, stop the madness. This is crazy. And then the Fed spent 3 years, 2015 to 18, raising rates and starting to run down its balance sheet. What happened to asset prices other than government bonds? equities continue to go up, privates went up, and they found a way to do it. So the central banks have found a recipe where they can provide emergency stimulus, and then they can begin to work it out when the economy is strong enough to absorb it.
Hey, so Bob, as an extension of that question a little bit, last summer when the 2-10 yield inverted, right, and we had basically a matched low of the 2016 low in the 10-year Treasury down there at 140 or something like that, there was a lot of fears about recession. So you just said under certain circumstances you could see a retest of that 2016 low. What happens if they break it, right? What happens if that yield curve gets inverted? We're that much further along where everybody, strategists and economists, were saying that it's a 100% indicator when it inverts 18 to 24 months out, we get a recession. What's your view if that happens sooner than later?
So that's a great point. The Fed didn't start cutting rates until later in July of last year. So the curve was inverted for a while. These 90 or so central bank cuts, they were back and loaded, and they were responding to what they felt was a manufacturing recession globally could ripple through to the consumer side. And then you had a phase one trade deal. I think they're eyeing what's going on with the coronavirus. If it does take a lot out of global GDP, they'll respond and they'll see how far they go.
I know it's early. I'm sure you've been in contact with your colleagues in Asia, or at least that part of the world.
Absolutely.
What are the chances that in reaction to this, there will be a day when this does come to an end, that the Chinese government, which is known for using the iron fist as much as the velvet glove, will flood its own market with liquidity, will bring in its own bigger form of stimulus? They're already kind of doing one right now. In other words, does the Chinese government and its central bank have the financial firepower to counter or even overshoot the negative economic impacts of this?
To some extent, yes. I think they've learned from 2003 and SARS. You're already seeing it with the faster, more deliberate response, with the immediate quarantining, the sharing of information, the transparency. I think you can project that onto the capital markets and say they would inject more liquidity to try to stabilize things here, and they have the ability to do it. Maybe
it's a matter of time. Maybe it will ultimately, they'll push that system up. Bob Michel, head of global fixed income at JP Morgan. Bob, thank you very much for joining us. It's interesting too, Guy, because we talk about SARS. It's really the only sort of China-based historical context that we have. But let's be clear, in 2003, the Chinese economy was smaller than that of the state of New York, 1.6 trillion in GDP. It's 14 trillion now. Yeah. It's a whole different animal.
And Dan Nathan made that point on our 12:30 call, which we have each day. I mean, it's an excellent point. And the markets were in a much different place at that time. I don't think there's any way you can draw conclusions based on what happened 17 years ago. I mean, we can try, but I don't know what the point is. And again, I'll push back quickly. We fear every central banker says, we're trying to avoid recessions. Why? Why try to avoid recessions? They're a natural part of the business cycle. It's like you just allow it to happen, and it won't be 10 times as bad 5 years from now. It's painful, but it's necessary, and it allows good companies to flourish and bad companies to get out of the way. It's corporate Darwinism, and for some reason we're not allowing it to happen, and Federal Reserve is square one the culprit in this, my opinion.